What's up, everyone, and welcome to the Daily Macro Update for Wednesday, March 4th. Taking a look at the macro data for today, we had some mixed numbers with the ISM Services PMI, which is probably the most important leading indicator of the aggregate economy in the United States here. So we'll get into that, as well as some of the market reaction, which heavily skewed towards just one of the ISM PMI reports. I just made a short video about it, but we'll cover some of that in here, as well as get the market reaction and get after some questions after that. I know that yesterday my stream was a little bit disrupted, but today we're going to make sure that we make up for it here. And so, yeah, let's go ahead and get right into it here. Taking a look at the headline for today, the United States service sector growth printed at over a 3-year high. That's talking about the ISM Services PMI here. Let me see if I can find it. Here we go. Yeah, so the ISM Services PMI, this is essentially showing, focusing on services in the United States economy. Why is this important? Services make up over 70% of consumption. The United States is a service-based economy, so we should be looking at these as leading indicators. The only problem is that when taking a look at the S&P Global Services PMI, that actually had a complete opposite reading here. Let me see if I can find it. Let's see. I think it's this one right here. Yep. All right. So, yeah, taking a look at the services PMI from S&P Global, this printed at an 11-month low, and is pretty much a clear deceleration that we've been seeing since the July print. And so, which one of these is correct? And I did address this on the recent video that I made. But really, the major thing here is that which one is more accurate when looking at historical accuracy with predicting what the GDP number is. And historically speaking, the S&P Global has been a lot better of a predictor, but the ISM Services PMI, this has been pretty much the main indicator that the market pays attention to and carries the most weight, I should say. So it's not something to ignore, but with this huge upward surprise here, we are seeing risk on assets like Bitcoin, as well as this, speculative liquidity ratio that I like to look at, which is Bitcoin versus the NASDAQ, that had a pretty decent spike here. But not just that. I mean, you've had different accelerations as well across other assets that are performing well. Yeah, I mean, a lot of the things that have been down a lot, though, are up today. So things like tech, discretionary, financials, all these things are essentially having bear market bounces. And so as much as I would like to say that Bitcoin is back, when things go down a lot, they tend to bounce, right? And that's pretty much what we are seeing right now. There was a couple of volume spikes that was interesting with Bitcoin, but Bitcoin still has to do a lot of work here in order to get back to a bullish trend in our model. So still bearish, but this excitement from today pretty much was able to be a pretty decent selling opportunity in terms of, sort of that near term risk management, right? Because the actual macro market hasn't changed at all. So, yeah, that's what I saw. But taking a look at the differences between both the ISM and the S&P Global PMIs, um, they came out with a comparison article, and this is from S&P Global, so it's probably a little bit biased here, but the main differences I think are pretty important, right? So the S&P Global tracks services in the private sector, right? So only private sector activity with S&P Global, where ISM also considers government services, right? So it takes in that data. There's a bunch of other differences as well, but ultimately, what we want to make sure of is what's the accuracy between these two with providing a picture with GDP, right? Because the official GDP numbers come out on a quarterly basis. And so a lot of things happen in 3 months, right? And so what we want to do is we want to make sure that we are tracking leading indicators to better prepare us for what trend that potential GDP number could be. And so, as we saw, taking a look at the macro indicator dashboard on our website, macro-optics.com, and going to the US growth chart here, you can see by just looking at this that, government spending has been declining on a quarter over quarter basis. We've been seeing a large acceleration or a continued acceleration in equipment, right? So that's a lot of that has to do with the AI investment, but really, what's interesting is that when you take a look at both services, that's kind of remained, similar at similar levels. But what has really dropped off is durable goods, and that's partly due to tariffs. But as you can see, it's a lot different of a GDP environment than where we were at just a year ago. You know. So we'll see what happens with that, though. Taking a look at the actual services PMI for S&P Global, that did come down at the lowest number since April of last year. And again, this is a 7th month deceleration. So I'm going to go with the one that is more accurate here. But you had a lot of you had a lot of people getting excited on this bounce in Bitcoin here. But yeah, it went. Let's see on the trading range. It went way above the top end of the trading range there. So, this is essentially a great time to sell some or, de-risk out of it until it can, maintain or start to regain some strength and lose its bearish trend, which, I mean, this is the first start if it was to do it from here. But I wouldn't be surprised if it does continue to bounce, but it does take a little while for something like this to get back to bullish trend after it's gone down just a ton. So that's what we are seeing here in the markets. But yeah, Ethereum, Bitcoin miners, XRP, Solana, all of those were the biggest movers today. Other than that, we had a little bit of a rebound in things like platinum, PPLT, as well as Mexico. So yeah, I mean, if you're buying some dips in those over the past couple days, nice move. You can sell some today for some quick cash. These are the types of things that you want to be looking for. And, if you're having some issue with navigating this market cycle right now, especially in this environment where there's higher than average inflation, higher than average interest rates, and in turn, higher than average volatility, then I would highly recommend that you guys track macro data as well as incorporate it into your process, whether you're only doing technicals on the charts or whether you're solely based off of fundamentals or you do a mix of the two. You have to incorporate macro in this post-pandemic environment. And if you're already doing that, great. If you're already finding a successful process in doing that, or you're part of a group, great. If you're not, though, you can take a look at our website here or take a look at the link in the description below for our 6-week macro mastery challenge. This is where you get essentially full access to our partnership circle tier in our group, where you get daily picks, pre-market videos that are exclusive to the group. We have a live chat where we're answering questions. You get a full training on our process as well as macro lingo. And we're just in there making some great moves, getting ahead of a lot of these market trends. And if that sounds like something that you want to try out, I would highly recommend taking a look at our 6 week challenge there and putting in an application and book a call with me to see if it's something that's a fit. But with that, though, taking a look at this at just the volume comparison on a price heat map here, decent little rebound here in the markets today. But again, it's not enough of a move to change any of the trends that are currently established. So, if you own some of these things, it's been a great time to sell some of that into strength and raise some cash. So hopefully that's what everyone was doing today on this bounce instead of panic FOMOing into it. If you guys were chasing and buying this thing today, man, I don't know what to say. That's the exact opposite of the right move that you want to do. But yeah, that's pretty much all I have. Looks like the VIX is about to close still above 20, which is pretty interesting. Still high volatility. We're definitely not out of this high volatility regime here. So got to be cautious. Got to be cautious. But let's go ahead and get into some questions here. How's everyone doing? Friday, we have a pretty decent day in the economic calendar. I think, yeah, on Friday, we have non farm payrolls. So the jobs numbers, retail sales, unemployment, and as well as core retail sales. So that's going to be a pretty decent indicator in terms of the labor market as well as demand in terms of growth. Hey, Johnny, are you still bullish on XLP after it made a new low? Also, could you show me the trading ranges for wheat? Can't show you the trading ranges for wheat. You'll have to subscribe for that, but we can go over the chart here. Yeah, I mean, it remains in bullish trend and it's had a little bit of a sell off here. So, still looking pretty good. XLP. Yeah, I mean, I wouldn't say it made a new low. It's kind of just like at this level here, but it has been losing a little bit of trend. We'll see. Excuse me. We'll see what'll happen from here. Volume really needs to decline, but yeah, taking a look at the ranges, it's right at the low of the trading range. So um, I would want to see what happens from here. Like I'm not in a huge rush to buy this just yet. Um, because volume did accelerate on this down move here. So I would want to see maybe a couple more trading days of decelerating volume while it trends north at the low of the trading range. But everything else looks pretty good. I mean, XLP remains in bullish trend. And yeah, if we get another down day today on some lower volume, I'll probably pick some more up. Still got the core position though. You mentioned how Trump wanted this Iran war because the Fed won't lower rates. Can you explain how does war stimulate economy? Well, you can go into debt a lot easier in wartime, and that's typically when you have big regime changes. But I wasn't saying that Trump executed this war in Iran because of the debt that's going on. I was simply just pointing out that right around the time when you get to 120% plus debt to GDP, that's typically been around major conflicts in order to set something up to disinflate that over time. Um, so yeah, let me see if it can just show you like a decent image. I know that there's a bunch here. Yeah, so the last time it was, where it was at right now was 1946. What happened that year? And then what caused it to what caused the debt to GDP to decline after that significantly, which prompted a boom in the United States like we've never seen before. An entire generation was named after that boom post World War II, right? So it is interesting just seeing those trends. That's all I was saying. Some beautiful short opportunities today. Yes, sir, Matthew. That is right. Can you explain 30-day versus 90-day volatility? Yeah, I mean, it's just two things that you want to compare, right? Realized volatility is a calculation based off of, previous price action of whatever asset that you're looking at. And so yeah, when you compare longer term versus shorter term volatility, then you get a pretty decent comparison of where volatility could be trending, right? And so that's why we like to take a look at that indicator. And so yeah, it's a great question. Let me see if I can pop it up. Let me see if I can find like a decent chart that'll show you. We can just go to the S&P. Yeah, so for example, with the S&P 500 here, you had an interesting flip between the 30-day versus 90-day historical volatility right here. Really, it started on this move, but see how the 30-day just rose above and has been staying above it. Interesting how it just had a little bit of a crack down below it. Need to see a few more trading days to see, what trend it could be having here. But yeah, once you had that cross where the 30-day crossed above the 90-day, I mean, look how the performance has gone from there, right? Lower lows and lower highs. So 30 days should be over 90? No, other way around. 90-day volatility, the orange line should be above the blue line if you're looking for a asset that has decelerating volatility, which is, volatility is declining, that's good. Meta and Microsoft had lower volume bounces. Yeah, good examples right there. With oil being bullish, does this mark the beginning of the end for the business cycle? Because oil spiking this late in the business cycle usually signals that a recession is on the horizon. Um, Not necessarily. I'm pretty much out of the business of trying to predict recessions because, that just hasn't worked out over the past few years. So I'm much more inclined to just pay attention to the data that actually comes in, and also as well what the markets are pricing in. It's definitely pricing in a slowdown right now or a stagflationary setup, but I don't think that it's necessarily pricing in a recession. You know, Whenever we're in these types of environments where liquidity is tightening, labor market is frozen, you have liquidity drying up, you have things starting to roll over. Yeah, the likelihood or the chances of a recession definitely increase, but they're not guaranteed. And over the past few years, when we get into these types of environments in the cycle time, really since 2023, the market has pretty much just been bailed out by different forms of or different pockets of liquidity that have then been injected into the markets. So I wouldn't put it past the government to just continue to do that, because that's what they're doing right now is just um, short duration treasury bills are being bought by the Fed, and yeah, it's putting in a lot of liquidity into the markets, or at least it's sustaining it for the time being. Um, a lot of people thought that was QE because they wanted their Bitcoin bags pumped. But if you were falling for that narrative, you got punished over the last few months here. So hopefully that was not you. If it was, then take that as an indicator to realize that you could have some potential with learning different strategies and getting better. Um, yeah, that's all you have to really have to think about on that. Yeah, so here you go. This is a chart of the treasury securities owned by the Fed on their balance sheet, and that has gone from 4.19 trillion to 4.32. And so, yeah, that's what, 130 billion in treasuries being added to the Fed's balance sheet since December. That this is them just trying to maintain the current liquidity levels, right? That's not them doing QE. A lot of people confuse that and got too optimistic. So, all right, what type of questions we got? Check TikTok here. Fed Warsh coming in soon. Do you expect the markets to continue to chop until they know if he's dovish slash hawk? I mean, it could. That's another factor. You know, I think he's just going to fall in line with whatever the administration says. So we'll see. A lot of the times the market prices in something and then it turns out to be not as bad and then it reverses. So who knows? But we don't really know anything until he gets on stage and starts to give us a little bit more of his thoughts on the market and stuff like that. Speaking of labor markets, with SPX being bearish slash neutral, it's back to neutral now. Do you see unemployment rate skyrocketing once a bigger drawdown happens? Well, I mean, the labor market is a lagging indicator, right? So the market would continue to crash well before we got any type of labor market data that is showing like a panic or whatever. Um, so yeah, I mean, labor market data is such a lagging indicator that it's pretty much the last thing that moves, you know. Um, Looking at labor market data is so lagging that you can almost use it as a bull market starting indicator, right? Because as soon as the unemployment rate starts to spike and everyone's panicking, that's typically the time where the Fed is coming in and providing emergency stimulus and all those different things. And once you get that spike, it could be a good time to just buy some risk on assets. You know, that's how lagging of an indicator the labor market is. But yeah, I mean, the S&P 500, it's obviously lost a ton of strength. And yeah, I mean, if you've been owning it so far this year, what is it? Year to date, it's negative 0.13, basically flat to slightly down. So yeah, we're almost we're almost 3 months in, and the S&P is slightly negative. Can you give your thoughts on the rush to safety, long dollar, and whether you see it being temporary? No, I mean the dollar just went bullish trend in our model. So I mean, typically when something goes bullish in our model, that is showing some pretty strong upward momentum. So yeah, I mean if the dollar continues higher, then that could be even more trouble for emerging markets, which it already has, right? Our team got rid of essentially, the emerging markets, the emerging market ETFs that we were long over the past few months. just got rid of them once the dollar went bullish. Um, so I think whenever you have a bullish dollar like this, liquidity tends to exit speculative foreign markets and come back to the United States. It's also typically a signal of more, higher for longer type of policy with the Fed. It's more of a tightening signal. And so this, along with credit spreads rising and the move, bond volatility, the move index continuing to accelerate. Yeah, I mean, risks are definitely rising more and more. Does Philip Morris look like a buying opportunity? I didn't really like this candle that it just had yesterday on accelerating volume. So, nope, not actionable. How are credit spreads and bond volatility? What do you mean? How are they? They're good. No, credit spreads have been widening. And then bond volatility has also gone to bullish trend. And it continues higher. So definitely not out of the woods yet with this risk off environment. Today was just a good day to clear out any losers and raise some cash to get ready. Calm before the storm. Or we could bottom here. We'll see. But the rise in some of these credit market indicators doesn't make me believe that too much. All right, we'll go ahead and wrap it up there, everyone. I appreciate everyone for joining. As always, if you guys appreciate this content, hit like. If not, you can comment below what you thought about the episode here. Good luck out there, and we will catch you in tomorrow's daily macro update. Bye, everyone.